What's the difference between return on equity and earnings per share, or EPS? Return on equity is the net income divided by the total equity, whereas EPS is the net income divided by the total shares outstanding, or the average number of shares. The EPS is a good indicator of how well the people that are working at the firm are generating shareholder value. Every quarter, analysts predict what the earnings per share is going to be for public traded companies. Now, when they predict it, what happens is on the day when the earnings are announced, let's say the net income is higher than expected, what normally happens, or what logically should happen, is that the share price should go up in the after hours trading, or even briefly when the market opens. And if a company underperforms, for example, they get less than what was expected of them, then logically the share price should go down. However, as we all know, that's not always the case, because there's lots of times when companies beat the EPS estimates, but then the share price goes down. That is because sometimes there are so many factors out there that can determine which way a share price is going to go in that you cannot possibly justify which direction share price is going to go in just based on EPS alone. Let's take a look at Shopify, for example. Shopify in the past 6 months has beaten the EPS twice. However, the share price has gone down more than 20%. All justifications aside, generally speaking, the higher the EPS, the better. A higher EPS, good. Lower EPS, bad. If you would like to see similar content, don't forget to follow. And I would also like to plug in this perfume. If you've never tried oud perfume before, then this is the one to try. Buy it now for $9.99.